Thank you very much. And first, I would like to thank City Securities and Guardian for inviting me. I'm sorry I don't speak Chinese, so my presentation will be entirely in English. These are very interesting times in the financial and political landscape of the world. The economy of the so-called emerging markets, led by China, is starting to dominate the global trade as well as global policy making, and the Western world is starting to look at these markets very seriously from a profit potential. Second big problem is historical data crunching. Many investors will look at historical returns and say, okay, just because this fund made 15% for the last 5 years, it'll make 15% for the next 5 years. Unfortunately, that is not the case. Xi Shen Yu On Bian, which is facts speak louder than words. I know my pronunciation was probably very bad, I'm sorry. But here is some analysis that shows that really bucketing by asset class and geography does not lead to diversification. When does an investor need the benefits of diversification the most? At times when there's a crisis. When the markets are normal, markets are moving with low volatility, then diversification, people don't really look for the benefits of diversification. You need it at the time when the worst crisis hits. Now, a lot of people would wonder, why is it? Because a long time ago, there used to be diversification that you can get by going into different geographies and different asset classes. Why has that changed now? The main reason for that is global money printing. Because the money supply has increased so much, there are like trillions and trillions of dollars that are sitting with institutional investors that need to be put to work. So before, you would have maybe the pension funds investing in equity markets. You would have farmers and commodity areas, they invest in commodities. You have other people investing in bonds. But now, there's so much money with every institutional investor that they cannot invest in just one asset class or one region. To put all the money to work, they have to invest in every single asset class. So now the world has gone to two states. There's risk on, risk off. When there's risk on, all the investors go into all the asset classes and all the geography. That's why you will see the Dow is up, all the global equity markets are up at the same time. Dow is down, the market goes to risk-off state, all the money comes out. So the biggest reason why, that's what I'm saying, that it's not a cyclical change. This is actually a systematic change that has happened in the market, where we've gone from a risk-off, where you could get diversification by geography and asset class, to a market where it's basically two states, risk on or risk off.